Ann, it's great to see you again. Welcome.
Nice to see you too, Kelly.
So,
Happy Thanksgiving.
Yes, you too. One of the things that jumped out to me, it's something that Stephanie Link and others have been talking about, but if you go back to July, the Mag 7 outside of Tesla have really been underperforming relative to the equal-weighted S&P 500, and that's got to be a good sign.
It is a good sign, and I think there's probably legs to that type of action. Maybe not, every day, every week, but I think this broadening out should be thought of as one that does favor equal weight relative to cap weight. One of the things that I say, you're right to point out the relative underperformance on the part of the Mag 7. I think there were several fundamental reasons why that kicked in mid-July. But I had a client ask me recently, do you think you're better off doing equal weight or cap weight X the Magnificent Seven? And I said, boy, it's a big risk if you're going to exclude those names altogether. At least with equal weight, you get exposure. You just don't get the concentration risk associated with what they represent in the cap weighted indexes.
No, I think that makes a lot of sense, because far be it from any of us to try to figure out, what's going to happen with NVIDIA, for instance, or Meta or Microsoft or whatever from here. So let's talk a little bit about the froth that has people concerned. I mean, you could kind of point to a couple of stocks. Like we talked about hims and hers recently. There's areas of the market that you wonder if they look like they're a little bit too liquidity fueled. Do you think that's sort of where the concern comes from?
Well, maybe a combination of liquidity fueled and hype fueled. Momentum has been a huge force. Now, within the traditional equity market, leaving aside things like crypto and things related to that, within the equity world, one of the interesting things is that momentum as a factor has been as dominant recently as it was back in the late 1990s. Whoa. The good news is that the fundamental factor most highly correlated to the momentum into the peak in 2000 was negative earnings. Now the fundamental factors most correlated to momentum are higher quality factors like stronger return on equity, higher interest coverage. And I think that type of relationship is likely to persist. It doesn't mean we don't have valuation excess, but I think that's part of why we're seeing this convergence a bit in the Mag 7 type names and other parts of the market starting to show some life, particularly in areas like the financials. I do think, though, that you're likely to continue to see high sector dispersion and rapid fire sector rotations, at times back into groups like the Mag 7. But I think it's going to be harder to navigate at the sector level. I think it's going to be easier to navigate at the factor level, investing based on characteristics.
Do you kind of find it concerning that the yield curve went from on its way towards a merry steepening to all of a sudden flat and even inverted, which is another way of asking about rates and kind of how this all relates back to equities?
Well, the inversion of the yield curve obviously was seen as a precursor to recession with lots of variability in terms of time lags, and it didn't pan out. I think there's so many unique aspects to this cycle, not least being the fact that as interest rates were going up and you inverted the yield curve, we had the difference this time of corporations having termed out debt, of a lot of mortgage owners, their effective mortgage rate being significantly lower than the stated mortgage rate. The fact that you have a lot of corporations that really didn't need the capital markets. They didn't even need the banking system. They had a lot of access to capital. So it's really tempered that direct impact from shifts in the yield curve to what it means for the equity market. That said, I think the reinversion is a lot of enthusiasm about Bessent being chosen as Treasury Secretary and maybe calming some of those fears associated with the extremes on the tariff front and what that likely would have done to inflation, to Fed policy. But that's a very near-term assessment, and that's been happening on a day-to-day basis in the aftermath of the election. I'd be careful about extrapolating, even at this point, these post-election trends until we have a better sense of the differential between policy proposals and assumption around candidates for cabinet positions and what's actually going to happen with policy.